What you should know. Before beginning this guide, you should understand basic principles and terminology used in real estate investing. Which properties to look for and why. Where you want to buy real estate. How to locate motivated sellers. How to do income property analysis. Basics of investment strategies. What you will learn. This guide covers the following learning objectives. Know the most common types of retirement funds. Understand retirement terminology. List the restrictions on IRAs. List the IRA myths. Know the advantages and disadvantages to retirement plans. Know what to look for in a custodian. Know how to apply the strategy. Describe the profiles associated with retirement plans. Describe the self-directed 401k. Reasons to invest. Investing retirement funds in real estate can be lucrative and secure. Here are 7 reasons why you might consider using your retirement funds to invest in real estate. Low risk. Purchasing real estate for your IRA is beneficial because it is a low-risk investment, despite the popular belief that suggests otherwise. Real estate is insured against common forms of loss like fire and natural disaster. The same certainly cannot be said for other investments. Higher returns. A self-directed IRA invested in real estate can bring you higher returns, guaranteed. There are even companies out there that will guarantee to pay the difference if your returns aren't at least doubled after joining them. Real estate more stable than stocks. Real estate is a relatively stable investment compared to stocks. Stocks fluctuate in value every day, while the price of real estate is generally stable and tends to increase over time. High demand. There is always going to be a high demand for real estate since people are always going to need homes. Socially responsible investing. By purchasing real estate in your IRA, you can get involved in socially responsible investing. There are companies out there that buy up old homes in neglected urban areas, renovate them, and then resell them to working-class families. Investors get a portion of the profits from selling the homes. It is a win-win situation for everyone involved. More control. By having a self-directed IRA invested in real estate, you will have much greater control over your account. When you have a traditional IRA or 401k, you only know what is going on with your account when quarterly reports come in. When you have a self-directed account, you can choose an account custodian who listens to your wants and acts in your best interest. Your account custodian will keep you up to date on all matters that pertain your account instead of leaving you in the dark like banks will often do. When you self-direct your account, you will get higher returns without having to do any extra work. Lucrative. Finally, purchasing real estate in your IRA is highly lucrative because real estate is an untapped market. There are few people that self-direct their IRA accounts and invest in real estate, mostly due to all of the misinformation out there. Banks tend to discourage their customers from self-directed IRAs because it means less profit for them. Basic retirement plan terminology. There will be a lot of new terminology introduced in this guide. We will define some of the more common terms that you will need to know if you are going to use an IRA to invest in real estate. Socially responsible investing. By purchasing real estate in your IRA, you can get involved in socially responsible investing. There are companies out there that buy up old homes in neglected urban areas, renovate them, and then resell them to working-class families. Investors get a portion of the profits from selling the homes. It is a win-win situation for everyone involved. More control. By having a self-directed IRA invested in real estate, you will have much greater control over your account. When you have a traditional IRA or 401k, you only know what is going on with your account when quarterly reports come in. When you have a self-directed account, you can choose an account custodian who listens to your wants and acts in your best interest. Your account custodian will keep you up to date on all matters that pertain your account instead of leaving you in the dark like banks will often do. When you self-direct your account, you will get higher returns without having to do any extra work. Lucrative. Finally, purchasing real estate in your IRA is highly lucrative because real estate is an untapped market. There are few people that self-direct their IRA accounts and invest in real estate, mostly due to all of the misinformation out there. Banks tend to discourage their customers from self-directed IRAs because it means less profit for them. Basic retirement plan terminology. There will be a lot of new terminology introduced in this guide. We will define some of the more common terms that you will need to know if you are going to use an IRA to invest in real estate. 401k plans. A 401k is an employer-sponsored retirement plan designed to provide tax advantages on an employee's retirement savings. 401k plans must be sponsored by an employer who acts as a fiduciary for the account. The employer, usually a corporation, is responsible for the establishment of the plan and for the selection of plan investments. Once the plan has been established, the employee defers a portion of his or her annual salary into the fund. The limitations of a 401k are easy to see because a 401k is an investment plan that is controlled by the company you work for. They choose the best investments for them, limit how much you can contribute, and prevent you from self-directing your money, as that will reduce their profits. With a company-sponsored 401k, you have very little control over the money you contribute. On the plus side, the IRS maximum contribution limits for defined contribution plans allow individuals and their employers to contribute more than ever before to a 401k plan. In addition, many 401k plans have a loan feature that can let its owners withdraw cash in times of need. When these loans are repaid, the funds then become part of the 401k balance. If you are changing jobs, then you will have to transfer or roll over your 401k into IRA funds, since 401ks are employer-sponsored. Self-employed individuals can set up a 401k plan because of recent legal changes to these accounts. They just need to find a custodial company that offers self-managed 401ks, and you can invest the fund in anything from real estate to tax liens or stick with the more traditional, but fluctuating stock market. Keogh plans. A Keogh is a tax-deferred pension account designated for employees of unincorporated businesses or for persons who are self-employed, either full-time or part-time. Like the IRA, the Keogh plan, also known as HR 10, allows all investment earnings to grow tax-deferred until capital is withdrawn, as early as age 59.5 and starting no later than age 70.5. Almost any investment, except physical real estate and collectibles, can be used for a Keogh account. Typically, people place Keogh assets in stocks, bonds, money market funds, certificates of deposit, mutual funds, or limited partnerships. The Keogh plan, named after U.S. Representative Eugene James Keogh, was established by Congress in 1962 and was expanded in the Economic Recovery Tax Act of 1981. Employers can deduct, up to certain limits, the contributions they make to Keogh plans, including those made for their own retirement. The three most common types of Keoghs are profit sharing, money purchase, and combination plans, all of which fall under the category of defined contribution plans. Profit sharing plans. These plans are an arrangement between an employer and employees in which the former shares part of its profits with the latter. Profit-sharing plans are a way to keep employee morale, loyalty, and retention up. Employees can be given stocks, often stock in the company they work for, or bonds, or cash. The employer uses government-approved formulas to determine how much an employee will receive with profit sharing. If the profit-sharing contributions are part of an employee's retirement plan, they are received at retirement rather than now. They may be tax-deductible. There are eligibility requirements for profit-sharing plans. For example, the employee must work for the company for a certain period before he or she can partake in profit sharing. IRA plans. An IRA is a custodial account or trust in which individuals may set aside earned income in a tax-deferred retirement plan. IRAs can be established at a bank, mutual fund, or brokerage. Only those who do not participate in a pension plan at work or who do participate and meet certain income guidelines can make tax-deductible contributions to an IRA. Such contributions qualify as a deduction against income earned in that year, and interest accumulates tax-deferred until the funds are withdrawn. A participant is able to roll over a distribution to another IRA or withdraw funds using a special schedule of early payments made over the participant's life expectancy. This guide covers all of the different types of IRAs, but will focus mainly traditional and Roth IRAs. There are several types of IRAs that you might hear about. Traditional IRA. IRAs were first developed in 1974 for people to put money aside for their retirement. Traditional IRAs have annual contribution limits, which vary each year. Earnings on the account are tax-deferred until withdrawal, which must begin at age 70 and a half. The main advantage of traditional IRAs is that it allows a person's money to grow tax-free. Distributions are then taxed at age 71.5. If the distributions are not taken, then there is a 50% penalty on the amount not taken. The traditional IRA taxes individuals at the time of retirement when they are in a lower tax bracket, thus meaning they generally pay fewer taxes on their savings when the money was withdrawn than when it was earned. The traditional IRA is not as powerful as the Roth IRA, however. Roth IRA. Roth IRAs are a relatively new creation with a few benefits over traditional IRAs. Although you can't defer taxes on the money originally invested in a Roth IRA, all the income earned by the investments in a Roth account is tax-free when it is withdrawn. Another benefit is that you are not required to take distributions beginning at age 70 and a half as with other accounts, so if you don't need the money to live on, it can continue growing and earning for you tax-free. Unlike traditional IRAs, Roth IRAs allow you to make contributions after age 70 and a half. Also, a Roth IRA makes it easier to take early withdrawals without penalties in some cases, compared to other retirement accounts. Roth IRAs can provide a tax-free source of retirement income. Roth distributions are tax-free if you begin withdrawals at least 5 years after establishing the account, and you are at least age 59 and a half at the time of the withdrawal, or you are disabled or deceased. Roth IRA rules also allow mostly for the investor to put his or her money into a wider variety of investments other than just the traditional money market accounts and mutual funds. The hottest investment through these accounts currently is real estate, instruments secured by real estate, and other physical property. There are certain custodians who are authorized to invest Roth IRA funds into these types of investments. If you are going to invest in real estate-related investments, you will need to locate one of these custodians. Group IRA or Employer and Employee Association Trust Account. This is a traditional IRA established by an employer for employees. Simplified Employee Pension. This is a traditional IRA established by an employer for employees. Employer contributions can be up to a certain percent of an employee's annual compensation. Savings Incentive Matching Plan for Employers IRA, Simple IRA. This is a traditional IRA established by small companies for employees. Participants can contribute up to a certain amount a year. It changes from year to year. Employers will match a portion of the employee's contribution. Spousal IRA. This is a traditional or a Roth IRA set up by a married person in the name of his or her spouse who has an annual income of less than a predetermined cap amount. There is a limit on spousal IRA contributions, but the working spouse can contribute an additional predetermined amount of money to an individual IRA. Couples must file jointly in that year. Rollover or conduit IRA. Rollover IRAs are established by an individual to receive a distribution from a qualified retirement plan, such as a 401k. There is no limit on the contributions transferred to a rollover IRA. The amount in the new account is eligible for a consecutive transfer into a new employer's qualified retirement plan. Inherited IRA. An inherited IRA is a traditional or Roth IRA given to a non-spousal beneficiary of a deceased IRA owner. The beneficiary must make required yearly distributions from the IRA or suffer tax penalties. In addition, this type of IRA does not allow for tax deduction contributions and rollovers to and from other IRAs. The IRA can also be paid as an annuity or in periodic installments not extending beyond the beneficiary's life expectancy. If the IRA owner dies before naming a beneficiary and has not started taking the minimum required distributions, MRD, at age 70 and a half, then the IRA is paid to the estate by December 31st of the 5th year after the death of the owner. If the owner had already started taking the MRD, then the IRA is paid to the estate over time based on the owner's life expectancy. Time limits. One of the basics of the IRA rollover rules is the time limit for making the rollover. Typically, a rollover is from one account to another, which is done simultaneously, but you can take up to 60 days to do the rollover. For example, if your IRA was in the stock market and you sold your stock on July 8, 2008 and you wanted to invest the proceeds into real estate but you haven't found the right property yet, you have 60 days or until September 6, 2008 to find the right property for your IRA rollovers in order to avoid paying taxes on the amount of stock you sold. 1 year wait. The second major rule is you generally have to wait at least 1 year between rollovers from the same IRA account. For example, if you have two IRA accounts, IRA 1 and IRA 2, and you want to do an IRA rollover from IRA 1 to a new IRA on July 8, 2008, you would not be allowed to do another rollover from IRA 1 or IRA 2 until July 8, 2009, 1 year later. However, the rollover between IRA 1 and IRA 3 does not prevent you from making an IRA rollover from your IRA 2 account into an IRA 4 account during the period between July 8, 2008 and July 8, 2009. Transaction restrictions. The IRS has identified some restrictions on the types of transactions you can do with your IRA. Generally, a prohibited transaction is any improper use of your traditional IRA account or annuity by you, your beneficiary, or any disqualified person, which include your fiduciary and members of your family, spouse, ancestor, lineal descendant, and any spouse of a lineal descendant. Prohibited transactions. The following are examples of prohibited transactions with a traditional IRA. Borrowing money from the IRA. Selling property to the IRA. Receiving unreasonable compensation for management. Using the IRA as security for a loan. Buying property for personal use, present or future, with IRA funds. The IRS prohibits certain transactions with IRAs. Prohibited transactions include investments with disqualified individuals, self-dealing, and receiving indirect benefits. Investments made with self-directed IRAs must be at arm's length, which is most often defined as a willing buyer and willing seller coming together with no undue influence from outside sources. The trustee or custodian must be a bank, financial institution, or other entity approved by the IRS. Contributions must be in cash, not property such as securities, and must not be more than the maximum allowable amount per year, except for rollover contributions. You must have a non-forfeitable right to the account. You cannot use the money in the account to buy a life insurance policy. The account must be separate. The assets, securities, in your IRA cannot be combined with other property, except in a common trust fund or common investment fund. Disqualified persons. Disqualified persons are individuals or entities between whom or which an IRA is prohibited, absent a special exception, from engaging in any direct or indirect sale or exchange or leasing of any property, lending of money or other extension of credit, furnishing goods, services or facilities, or transferring to or permitting the use of IRA income or assets. Fiduciaries, which in the case of a self-directed IRA includes you, as the IRA owner. The following family members of the IRA owner: spouse, parents, grandparents and great-grandparents, children and their spouses, grandchildren and great-grandchildren and their spouses. Note, a disqualified person under the IRS code does not include siblings, brothers and sisters, or aunts, uncles and cousins of the IRA owner. Service providers of the IRA, example, IRA custodian, CPA, financial planner. An entity, such as a corporation, partnership, limited liability company, trust or estate, of which 50% or more is owned directly or indirectly or held by a fiduciary or service provider, also a 10% or more partner or joint venturer of such entity. Additionally, in the case of a SCP or simple IRA, this includes the individual's employer, Section 50% or more owner of the employer, officers, directors, 10% or more shareholders, and highly compensated employees of the employer, an entity 50% or more owned by the employer, Section 10% or more partner or joint venturer of the employer. Self-dealing. Please note that you, as owner of the account, are a disqualified individual. In the eyes of the IRS, you and your IRA are not one and the same. Although the IRA is established to benefit you and your beneficiaries, it is truly a separate trust. An IRA cannot buy or sell investments from the IRA owner. Here are some examples of self-dealing. Having your IRA purchase real estate that you own presently. Having your IRA purchase real estate that is owned by a family member of lineal descent, such as your father. Issuing a mortgage on a relative's new residence purchased by a family member who is a disqualified person as listed above. Granting a child a second mortgage for the down payment on his or her first home. Buying stock from the IRA owner. Any transaction involving IRA funds and a disqualified person is prohibited. Purchasing stock in a closely held corporation in which the IRA owner has a controlling equity position, or, if such corporation is the IRA owner's employer, in which the IRA owner is an officer if the IRA is established pursuant to the employer's SAP or simple program. Purchasing restricted stock from a family member who is a disqualified person listed above. You can only invest in real estate if it is providing income for you. You cannot invest in real estate if the property is for you or your immediate family. Therefore, it must be cash flowing or sold. To own real estate in your IRA requires you to keep the monthly income coming in from the property separate from any other income you may have. In practice, this means do not deposit money from an IRA real estate in your household or personal account. Do not even have the checks made out to you personally, but instead the checks should be made out to the IRA. Having checks made out to you personally or deposited into your personal account could be a prohibited action and would cause the real estate in your IRA to revert to a non-IRA asset, which would mean it would be taxed as regular income. Also, your property expenses must be kept separate and paid out of the IRA account and not your personal account. Income restrictions. One important restriction to the IRA rules is that if you are single or file a single tax return, you must make earned income at a pre-designated amount per year or less, and less than a pre-designated amount per year if you file a tax return jointly with your spouse. You will want to check with your custodian or accountant for the yearly amounts. Restricted investments, your own company. There is sometimes confusion about this, but if you own a company, either outright or by 50% or more, your retirement account cannot invest in that company. You can, however, form an LLC within the account to further protect your assets. An LLC would also allow you to hire individuals or teams to manage investment properties, do maintenance, repairs, and other tasks necessary in the housing market. Converting an IRA. Finally, you may convert a traditional IRA to a Roth IRA in any year your average gross income doesn't exceed that year's income cap amount, provided your tax status is not married filing separately. However, the amount you convert from a traditional IRA to a Roth IRA is generally considered part of your taxable income for the year of conversion, or you may incur this penalty if you subsequently withdraw converted funds from the Roth IRA before age 59.5 and sooner than 5 years after establishing your Roth IRA. Your financial professional or tax advisor should be able to offer you more detailed information on conversion-related issues and income cap amounts. Common IRA plans' advantages and disadvantages. Following are the advantages and disadvantages of more common IRA plans. Traditional IRA advantages. Here are some specific advantages to traditional IRAs. Contributions tax deductible. A traditional IRA contributions may be fully or partially tax deductible, and earnings in the account can grow tax-free until distributed. Available to most people. You can set up a traditional IRA and make contributions if you receive taxable compensation and you are under age 70.5. Roth IRA advantages. Here are some advantages specific to Roth IRAs. All contributions made after tax. All qualified contributions are made with after-tax dollars, and therefore all monies in the account, including earnings, can be withdrawn tax-free with certain provisions. Good for high tax bracket individuals. If an individual expects to be in a higher tax bracket upon retirement, they should contribute maximum amounts of money towards a Roth IRA because money being invested in a Roth IRA is taxed at the current tax rates and will not be taxed when it is withdrawn upon retirement, when the Roth IRA owner may be in a higher tax bracket. No tax. There is no capital gains tax, no income tax, and no qualified distributions tax on any of the earnings that you make from a Roth IRA account. No restrictions based on previous enrollment. Contribution eligibility is not restricted by active participation in an employer's retirement plan. No minimum distribution rules. The minimum distribution rules don't apply to Roth IRAs. Unlike the traditional IRAs, you don't have to draw on your Roth IRA at age 70, which means your earnings continue to grow tax-free. Surviving spouse can combine Roth IRA accounts. If a Roth IRA owner dies and his spouse also owns a separate Roth IRA, the spouse is permitted to combine the two Roth IRAs into one single account without any penalties or fines. Limited early distributions allowed. You can take certain early distributions without paying any early distribution penalties. Traditional IRA disadvantages. Here are some disadvantages to traditional IRAs. Eligibility requirements. Traditional IRAs have eligibility requirements for tax deductibility. If you are eligible for a retirement plan at work, your income must be below a specific threshold. Withdrawals taxable. All withdrawals from a traditional IRA are included in gross income and subject to federal income tax, with the exception of any non-deductible contributions. There is a formula for determining how much of a withdrawal is not subject to tax. If your investment style is buy and hold or dividend seeking, stocks held in a traditional IRA lose the favorable tax treatment given to dividends and capital gains. Less income sheltered. If you have a lot of disposable income, a Roth IRA in effect shelters more assets from taxes on gains than does a traditional IRA. Suppose someone with $4,000 to invest is eligible to either contribute $4,000 to a Roth IRA or to a traditional IRA and deduct it. If they choose the traditional IRA, then they receive an upfront tax deduction worth, say, $1,000 to someone in the 25% tax bracket. When the money is withdrawn from the traditional IRA, it will be taxed at marginal rates. On the other hand, if they choose the Roth IRA, there is no upfront tax deduction, but the money and the gains are all exempt from taxes upon retirement. So individuals with much disposable income must be in a lower tax bracket when they retire to prefer a traditional IRA over a Roth IRA. Contribution limits. The amount you can contribute to a traditional IRA and deduct for income tax purposes is limited. The limit is subject to change and is published in the instructions and publications issued yearly by IRS. Forced distributions. Perhaps the greatest disadvantage of the traditional IRA is its forced distributions. Withdrawals must begin at age 70 and a half, more precisely, April 1st of the calendar year after age 70 and a half is reached, according to a complicated formula, and an annual minimum distribution must continue for as long as the individual lives. Self-directed IRAs. In order to invest retirement funds in real estate, you need to use a self-directed IRA or 401k. Self-directed IRAs have many more investment options than regular IRAs or 401k plans. Specifically, a self-directed IRA can be actively managed by the account holder who designates a custodian to carry out investment instructions. The self-directed account is subject to the same conditions and early withdrawal limitations as your type of IRA account, in example: Roth, traditional, SCP, or simple. Depending on the custodian, you can legally use your self-directed IRA to invest in the following: commercial real estate, undeveloped or raw land, real estate notes, mortgages and deeds of trusts, promissory notes, tax lien certificates, foreign currencies, oil and gas investments, equipment leasing, residential real estate, including apartments, single-family homes, and duplexes, publicly traded stocks, bonds, mutual funds, private stock offerings, private placements, judgments/structured settlements, gold bullion, car paper, factoring investments, accounts receivable, private limited partnerships, limited liability companies, and C corporations. Self-directed IRA advantages and disadvantages. Disadvantages. There are advantages and disadvantages to a self-directed retirement plan, whether it is a traditional IRA or Roth IRA. Advantages. In general, here are some of the advantages to a self-directed retirement plan. Diversification. With this kind of plan, you have the ability to diversify your investments and money. Control of funds. You have the ability to control where your retirement dollars are invested with an asset base you understand, and you can dictate the rate of return you get on your investments. Few restrictions. There are few restrictions on the kinds of assets you can invest in with the right custodian. Some of the IRA-permitted IRA investments are stocks, bonds, CDs, mutual funds, residential and commercial real estate, undeveloped land, gold bullion, tax lien certificates, LLCs, private limited partnerships, and C Corp, foreign currency, equipment leasing, oil and gas investments, judgments or structured settlements, promissory notes, factoring investments, accounts receivable, and car paper. Contribute at any time. You can make contributions at any time during the year, and contributions for the current year can be made the following year, up until the normal due date for your tax return, April 15th. If you make a contribution between January 1st and April 15th, you should tell the custodian which year, current or previous, it is for. No limits on use. There is no limit on how you use a self-directed IRA. You can invest the entire IRA amount in real estate. There are, however, a few disadvantages to a self-directed IRA. Separate accounts in same family. Spouses cannot have the same IRA account, they have to set up separate accounts. Lower contribution limits than with 401ks. Annual contribution limits are much higher in 401ks than they are in IRAs, and employers often match contributions on 401k plans, whereas there is no matching for IRAs. Myths about self-directed IRAs. Here are some common myths about self-directed IRA accounts that you need to be aware of so you can make a more informed decision about how to manage your retirement funds. IRA accounts require a lot of time. Anyone who tells you that self-directed Roth IRA accounts require a lot of time is wrong. There are custodian companies set up to help people who want to self-direct their IRAs. These companies provide an account custodian or trustee who listens to the account owner's needs and acts in their best interest. Roth IRA returns only about 2 to 3%. It is possible to double that amount at the very least if you self-direct your account, diversify your portfolio, and focus your investments on real estate. Fees are exorbitant. Some people think that you have to pay exorbitant fees for a custodian to manage a self-directed Roth IRA account. When you let banks manage or employers manage your retirement savings, you are actually getting charged big fees and only getting a small portion of the profits. With self-directed accounts, you pay very minimal annual fees and still get much higher returns in the end. Account holder is solely responsible for all transactions. Others claim that as the account holder, you are solely responsible for all the transactions and assets of your account when you have self-directed Roth IRA investments. Many people avoid self-directing their accounts because they have been lied to and told that they have to be highly knowledgeable and experienced investors to make the correct decisions. Legally, you are required to have an account custodian that helps you in the decision-making process, and the custodian is ultimately the one who conducts all of the transactions. No guarantee for maximized returns with self-directed Roth IRA. Some companies actually guarantee to double or even triple your returns, or they will pay you the difference. Furthermore, you don't have to pay any fees to roll over from a traditional account to a self-directed account. Your bank will try to discourage you from moving your money and tell you that there are hefty fees to pay in order to roll over to a self-directed IRA, but this is false. Finding a custodian. In order to take advantage of real estate investing, you need to find a custodian company that is set up to help you self-direct your account and invest in real estate. Look for a custodian and a company with the inside knowledge, connection, and experience necessary to invest in real estate and make bigger returns. Here are some things you need to consider as you search for a custodian. Allows IRA transactions. First, if you want to invest in real estate, you'll need to find an IRA custodian that allows real estate transactions to be made. No tax advice. Be aware that an IRA real estate custodian cannot give you legal or tax advice. They can only provide you with unbiased educational material or refer you to certain tax codes when appropriate. So, you're ultimately responsible for dealing with any legal issues that may come about. Custodians cannot suggest deals. An IRA real estate custodian is also not legally allowed to suggest good deals to a client. However, they can introduce you to advisors who can help find good deals. IRA custodians with a lot of connections and experience can provide you with many benefits than less-known custodians. Compare custodians. You need to shop for a custodian like you would for anything else. Compare the fees that they charge. You may think that all of them have the same charges, but many companies take on per-transaction fees that can become quite expensive, particularly when it comes to investing money in real estate. The best custodians charge a reasonable annual fee and a one-time setup fee. Experience. You should find a custodian experienced using IRA money for property investing. They will do all the necessary paperwork and comply with the regulations. Even some large custodian organizations are not experienced in real estate, so be sure to confirm their experience and expertise before making any binding commitments. Custodians correct errors quickly. Even with the best of intentions and careful administration, plan errors can occur. Some errors are minor and may be self-correctable. Other errors may require that you complete one of the voluntary correction programs offered by the IRS. If a plan error has occurred, a custodian must act quickly to ensure the appropriate corrective action is completed and controls are put in place to prevent a reoccurrence. Custodians cannot suggest deals. An IRA real estate custodian is also not legally allowed to suggest good deals to a client. However, they can introduce you to advisors who can help find good deals. IRA custodians with a lot of connections and experience can provide you with many benefits than less-known custodians. Compare custodians. You need to shop for a custodian, like you would for anything else. Compare the fees that they charge. You may think that all of them have the same charges, but many companies take on per transaction fees that can become quite expensive, particularly when it comes to investing money in real estate. The best custodians charge a reasonable annual fee and a one-time setup fee. Experience. You should find a custodian experienced using IRA money for property investing. They will do all the necessary paperwork and comply with the regulations. Even some large custodian organizations are not experienced in real estate, so be sure to confirm their experience and expertise before making any binding commitments. Custodians correct errors quickly. Even with the best of intentions and careful administration, plan errors can occur. Some errors are minor and may be self-correctable. Other errors may require that you complete one of the voluntary correction programs offered by the IRS. If a plan error has occurred, a custodian must act quickly to ensure the appropriate corrective action is completed and controls are put in place to prevent a reoccurrence. 3. Ensure correct title of your IRA investment. You and your IRA are two separate entities, and as such, the investment needs to be titled in the name of your IRA and not you personally. The correct title for most real estate IRA investments is Name of Custodian Company Custodian FBO, for benefit of your name, IRA. 4. Request funds to purchase IRA investment. Whenever you purchase an investment with your self-directed IRA, your custodian must do this on its behalf, using the correct investment forms and documentation. 5. Custodian remits funds and retains records. The custodian processes the form and sends funds for the investment based on the specifications. Once the transaction is complete, all records pertaining to the investment are sent to the custodian for safekeeping. 6. Maintain your IRA investment, how income and expenses flow. All payments/profits related to investing in your self-directed IRA must be made out to your IRA and returned to your account. In addition, all expenses related to your investment must be paid from your self-directed IRA. 7. If applicable, sell your IRA investment. Fill out the appropriate paperwork to instruct the custodian to sell the investment on behalf of your IRA. Funds from the sale are then returned to your self-directed IRA tax-free. Repairs. Using your IRA funds, you can make any necessary repairs and renovations to the property. Rent out or sell. You can either find a qualified buyer or rent out the property to make money on it. Profiles. The following are profiles of sellers, properties, and buyers that you should consider when you are investing in a self-directed IRA. Seller profiles. You can use your self-directed IRA to invest in many types of real estate. If you are buying property, you want someone who is motivated to sell and needs cash now so you can buy the property for less than fair market value and make a nice return. Again, your exit strategy will affect how you evaluate and calculate your offer to the seller. You can also buy tax liens and promissory notes with these funds. Refer to the Buying Notes lesson of the financing course and the Tax Liens lesson of the foreclosures course for more details on these types of investments. Property profiles. The property profile for self-directed IRAs is the same as the one that was described in the What to Look For lesson. As you should recall from that lesson, when you first start investing in real estate, you want to focus on single-family residences, SFRs. The reason SFRs are so good to focus on is because they are always in demand, and they are easier to sell or rent. Some of the property characteristics that you want to look for are detached dwellings, with at least 3 bedrooms and 1 or more baths that are in the low to median price range for the area and located in a decent neighborhood. The property can be in great condition or require minor repairs, depending on what you want to do with it and what you are able to spend on it. There are times when condos and townhomes are profitable, but since they are easily affected by market shifts, you should pursue them with caution. As mentioned earlier, you should review the tax liens or buy notes lessons if you choose to buy one of these investments with your self-directed IRA. Buyer/renter profiles. Many of your prospective buyers/renters have been denied conventional financing by lenders, or in the case of renters, may be accustomed to renting and don't feel comfortable trying to obtain financing. They may know they have a low credit score, high debt-to-income ratio, or a small down payment that would exclude them from traditional financing, so they might consider lease optioning or seller financing the property from you. Most often, these buyers want a home they can fix up while they rebuild their credit, save for a larger down payment, or pay off some of their debt. You may even come across a buyer who can qualify for a loan and wants to cash your IRA out. In the marketing courses, you will learn the best ad keywords to use in advertising to attract these kinds of buyers or renters. The buyers and renters you find will tell you exactly what they are looking for, allowing you to refine your investment criteria. Self-directed 401k. A self-directed 401k is technically no different than any other 401k, which provides a great tax break to employees who contribute to the plan. The self-directed 401k is unique because of the available investment options. Most custodians only allow approved stocks, bonds, mutual funds, and CDs. A truly self-directed IRA/401k custodian, such as an equity trust, allows those types of investments plus real estate, notes, private placements, tax lien certificates, and much more. In addition to the tremendous 401k benefits, tax-free profits, tax deductions, asset protection and estate planning, etc., you can invest tax-free in investments that you know and understand, which can create true wealth for you and your family through the power of compounding interest. The following are some details about 401ks. Key benefits. Some of the key benefits of a 401k plan include: high maximum contribution limit. Contributions are tax-deductible and are based on compensation or earned income. Roth contributions with after-tax income can be made for tax-free growth and withdrawals. Funds grow tax-deferred. Assets can be rolled over from other qualified plans or IRAs into a 401k. Loans can be made from a 401k, if allowed by the plan, for 50% of the account balance or $50,000, whichever is less. No business too small. No business is too small to have a 401k. Even a small business with no employees or employing a spouse only can establish a one-person 401k plan. This includes independent contractors with 1099 income, freelancers, sole proprietors, partnerships, limited liability companies, or corporations. Self-directed 401ks allowed. Self-directed 401ks are allowed under IRS rules as long as you follow relevant rules. IRS publications 560 and 590 clearly state the rules and regulations governing IRAs and qualified retirement plans such as 401ks. There's special rules for self-directed 401k investments to ensure compliance. You should be familiar with specific rules for 401ks and, in particular, self-directed 401ks. There are certain types of transactions that you cannot perform through a 401k. Most importantly, the IRS prohibits self-dealing, investments in which you or family members of lineal descent have prior ownership. Your self-directed 401k investments are not guaranteed. However, most successful investors feel that the investment risk in assets they know and understand is much less than the risk associated with making only conventional 401k investments. Rolling into an IRA. A 401k can be rolled into an IRA when the participant is no longer working for the organization, retires, becomes disabled, dies. Changing jobs with a 401k. The options for a 401k plan when changing jobs are as follows. Transfer the 401k plan assets into your new employer's 401k plan. Roll the 401k plan assets to a rollover IRA. Leave the 401k where it is, especially if you like your investment choices. However, if the balance is below $5,000, then some employers will require the plan participant to roll over the money. Note, 401k(b) assets cannot be rolled into a 403(b) and vice versa. Penalty-free withdrawals from a 401k. A plan participant can withdraw penalty-free distributions from a 401k as long as one of the following conditions applies. Reaches age 59 and a half. Separates from service in order to retire. Becomes disabled. Through a loan, some companies will not allow this. Dies. Suffers financial hardship. In conclusion, you have learned about some of the ways you can use retirement funds to invest in real estate. The guide is a snapshot of what self-directed IRAs are and how you can use them to invest in real estate. The purpose of this guide was to help you understand a few more options you may have to find funds to invest in real estate. If the stock market is uncertain or you want to grow your retirement funds faster, you can use real estate to do so. Before you start investing your retirement funds or someone else's in real estate, we do recommend having a good understanding of the Real Estate Basics course. The essentials of finding, evaluating, and profiting from real estate is offered in this course. You can share some of these options with others and see if they are interested in using their retirement funds to invest with you in real estate. Keep in mind, we are not financial planners, accountants, custodians, or anything like that, so we can give them basic information and then refer them to the right people to help them get their retirement funds set up so you can invest with them in real estate. Knowledge is power, and it gives you a lot more options than you would have had previously. You will find that no matter what your financial circumstances or credit standing is, you will always have options. You can make money in real estate no matter what with little or no money of your own down. If you follow what we teach in each of the financing lessons, you will find at least one way you can build wealth and a real estate portfolio.